Hey everyone, and welcome back to the channel. Today, we're diving deep into the world of technical analysis for stock trading. If you've ever looked at a stock chart and felt completely lost, this video is for you. We're going to break it down step by step so you can start using these tools to make more informed trading decisions. First up, what exactly is technical analysis? Simply put, it's a method of evaluating stocks by analyzing statistical trends gathered from trading activity, like price movement and volume. Unlike fundamental analysis, which looks at a company's financial health, technical analysis focuses purely on market behavior. The core idea is that all known information is already reflected in the stock's price. So, let's talk about the heart of technical analysis: price charts. You'll mainly see three types: line charts, bar charts, and the most popular one, candlestick charts. Candlesticks are amazing because they give you four key pieces of information at a glance: the opening price, the closing price, the high, and the low for a specific period. By looking at these candles, you can start to see patterns that reveal the psychology of the market, the battle between buyers and sellers. A crucial concept you need to master is support and resistance. Think of support as a price floor where buying interest is strong enough to stop the price from falling further. Resistance, on the other hand, is a price ceiling where selling pressure is strong and stops the price from rising higher. Identifying these levels is key because they help you find potential entry and exit points for your trades. Next, you need to identify the trend. Is the stock going up, down, or sideways? An uptrend is marked by a series of higher highs and higher lows. A downtrend has lower highs and lower lows. A sideways trend, or a range, is when the price just bounces between support and resistance. There's a famous saying in trading: the trend is your friend. Trading with the trend, rather than against it, usually increases your odds of success. As you get more comfortable reading charts, you'll start to notice common patterns. Things like the head and shoulders, double tops and double bottoms, or triangles and flags. These patterns are like road signs. They don't guarantee what will happen next, but they can give you a strong clue about where the price might be heading. Recognizing them can give you a real edge. To add more power to your analysis, we use technical indicators. These are mathematical calculations based on price, volume, or both. Some popular ones include moving averages, like the SMA and EMA, which helps smooth out price action and show the trend direction. The Relative Strength Index, or RSI, helps you spot overbought or oversold conditions. And the MACD is great for identifying momentum and potential trend changes. Volume is also a critical indicator. A price move with high volume is much more significant than one with low volume. So, how do you put it all together into a strategy? A common approach is to buy a stock near a support level during an uptrend. You'd look for confirmation from your indicators, maybe a bullish crossover on the MACD or an RSI that isn't overbought. For exiting, you might sell near a resistance level or when your indicators start showing signs of weakness. The key is to never rely on just one signal. Always look for multiple confirmations. And this brings us to the most important part of trading: risk management. I can't stress this enough. Always use a stop-loss order. This is an order you place to sell a stock automatically if it drops to a certain price, limiting your potential loss. A good rule of thumb is to never risk more than 1 or 2% of your trading capital on a single trade. Focus on your risk-to-reward ratio. For a trade to be worthwhile, your potential profit should be significantly greater than your potential loss. Keep in mind that the time frame you choose matters a lot. A day trader might use 1-minute or 5-minute charts, while a swing trader who holds positions for a few days or weeks will look at daily and 4-hour charts. Long-term investors might even use weekly or monthly charts to spot major trends. Make sure your time frame matches your trading style. Finally, remember that technical analysis is not a crystal ball. No indicator or pattern is correct 100% of the time. It's a game of probabilities, not certainties. Your success will depend just as much on your discipline, consistency, and emotional control as it does on your strategy. Don't let fear or greed drive your decisions. I hope this gives you a solid foundation to start exploring technical analysis. It takes practice, so start small, study charts, and see what works for you. If you found this video helpful, please hit that like button and subscribe for more content. Thanks for watching, and I'll see you in the next one.